Tonight, we're exploring the world of global tech investments, where fortunes are made and lost in the blink of an eye, and where the decisions of a few key players can ripple across continents. We'll do this through the lens of two giants, Prosus and Meituan, whose stories are deeply intertwined in the fast-paced world of technology and finance. Prosus, a Dutch-based tech investor spun out of South African giant Naspers, is a powerhouse in the global investment scene. It holds major stakes in internet companies worldwide, most famously in Tencent, one of China's largest tech firms. With a strategy focused on innovation and growth, Prosus actively manages a diverse portfolio, constantly buying, selling, and reshaping its holdings to maximize returns and stay ahead of market trends. Meituan, meanwhile, is a Chinese super app that's become essential to daily life in China. It offers everything from food delivery and ride-hailing to hotel bookings and movie tickets, making it a one-stop shop for millions. As one of China's top tech companies, Meituan's performance is closely watched by investors, as it signals the health and direction of China's vast consumer economy and digital landscape. Prosus invested in Meituan, betting big on China's digital growth story. But as global economic conditions shift and new priorities emerge, the relationship between these two companies has evolved. Now, Prosus is rebalancing its portfolio. Meituan remains a valuable yet volatile asset, reflecting both opportunity and risk in today's unpredictable markets. When a global investor like Prosus decides to sell a significant stake in a company like Meituan, it doesn't just affect the two companies involved, it sends shockwaves through the entire market, impacting investors and competitors alike. Is this a sign of lost confidence or a calculated strategic move? The answer is complex, involving Prosus's broader financial health, shifting global dynamics, and its long-term vision for growth. This sale is just one chapter in the ever-evolving story of global tech investing, where every move shapes the future of technology and finance on a worldwide scale. The big news: Prosus confirmed a $549 million sale of Meituan shares, a move that's making waves across both the tech and investment worlds. This significant transaction highlights Prosus's evolving approach to its portfolio, and it's drawing attention from analysts and investors alike. The sale was executed in two distinct phases, carefully spread out over several months to maximize value and minimize market impact. This wasn't a sudden exit, but a carefully managed reduction designed to avoid tanking Meituan's stock price and to maintain stability in the market. Prosus's strategy here was all about precision and timing. The first $249 million tranche was sold quietly in the first half of Prosus's fiscal year, setting the stage for a larger narrative and signaling the start of a gradual shift in their investment approach. The second, $300 million tranche, came in October, making the sale an ongoing, active part of Prosus's capital strategy and reinforcing their commitment to a measured, step-by-step process. By spreading out the sale, Prosus minimized disruption, avoided spooking the market, and signaled a clear move away from holding such a large Meituan stake, all while keeping investor confidence intact. This isn't panic, it's a strategic pivot, freeing up cash for new opportunities and giving Prosus the flexibility to respond to changing market conditions. The proceeds could go toward debt reduction, new investments in emerging sectors, or, as we'll see, a major share buyback program that could further boost shareholder value. For investors, this measured approach shows Prosus is actively managing risk, repositioning for the future, and demonstrating a thoughtful, forward-looking capital strategy. Prosus's latest earnings reveal a mix of growth and challenges, reflecting the dynamic nature of the markets they operate in. Revenue from its e-commerce portfolio rose to $3.62 billion, up from $2.96 billion last year, right in line with analyst expectations. This growth underscores the company's strong position in the digital marketplace. Adjusted EBITDA jumped to $530 million, more than double the prior year and slightly above forecasts, highlighting improved efficiency and cost management. However, adjusted EBIT was $400 million, up from $181 million but just below consensus, hinting at higher asset costs and some operational challenges. The company pre-announced a strong increase in core headline EPS, up over 20% year-over-year, which is a positive indicator for future profitability. This signals that despite some misses, Prosus's overall strategy is delivering value to shareholders, reinforcing their confidence in the company's long-term vision. The numbers show a company growing its top line and becoming more profitable, even as it navigates pockets of weakness and market volatility. For investors, the key takeaway is that Prosus is making progress on profitability and shareholder returns, which is crucial in a competitive market. The results aren't perfect, but the direction is positive, showing a clear path towards sustained growth. It's a story of operational improvement amid a complex investment landscape, where strategic decisions are beginning to pay off. Prosus's results are shaped by the performance of its diverse portfolio. iFood, the leading food delivery platform in Brazil, was a standout, with revenue hitting $880 million, well above expectations, driven by 11% order growth. This success highlights iFood's strong brand and market position. In contrast, eMAG, a major Romanian online retailer, missed revenue targets and struggled with profitability, reflecting tough European market conditions. Weakness at eMAG dragged on group results and raised questions about its long-term strategy. Meanwhile, OLX Group, operating online classifieds globally, delivered strong profits, offsetting some of eMAG's shortfall. OLX's high-margin model provided stability and resilience. This mix of winners and strugglers underscores the value of diversification in Prosus's portfolio. The company's fortunes depend on nurturing stars like iFood and OLX, while addressing underperformers like eMAG. iFood's performance is a bright spot for Prosus. As Brazil's top food delivery and grocery platform, iFood's $880 million revenue beat forecasts by nearly $100 million. Order growth of 11% in a mature market is impressive, showing both customer retention and new user acquisition. This growth likely stems from smart marketing, expansion, and new services. However, profits missed expectations by $5 million, suggesting higher costs to fuel that growth. The trade-off between rapid expansion and profitability is clear. iFood is prioritizing market share. For Prosus, iFood remains a key growth engine, but investors will watch for improved profits as the platform matures. Overall, iFood's momentum helps balance out weaker parts of the portfolio. eMAG and OLX tell two very different stories within Prosus's e-commerce segment. eMAG, facing weak consumer demand in Eastern Europe, missed revenue forecasts by over $100 million and struggled with profitability. This highlights the risks of direct e-commerce in tough markets. In contrast, OLX's global classifieds business thrived, benefiting from increased second-hand trading during economic uncertainty. OLX's strong profits helped offset eMAG's drag, keeping the e-commerce division on track. The lessened diversification cushions the impact of underperformers and showcases the strength of platform-based models. Prosus must now fix eMAG's issues while leveraging OLX's resilience. Mixed results perfectly describes Prosus's latest earnings. Clear wins, but also real challenges. Profitability surged, with adjusted EBITDA more than doubling, thanks to cost control and operational focus. iFood's revenue beat and OLX's profit strength were major positives, but eMAG's underperformance and slightly weaker adjusted EBIT tempered the good news. The company is in transition, growing profits in some areas while fixing problems in others. Management strategy is working overall, but the journey isn't smooth. The key nurture winners like iFood and OLX, and take action on laggards like eMAG. For investors, Prosus is a dynamic, evolving story, not a finished product. The mixed results highlight the need for active management and ongoing adaptation. The Meituan sale is just one part of Prosus's bold financial overhaul. Prosus also sold $4.6 billion of Tencent shares, not out of doubt, but to fund a massive share buyback program. This move boosted free cash flow, which hit $1.3 billion for the half year, thanks in part to Tencent dividends. Excluding those dividends, operational free cash flow turned positive, a sign of improving fundamentals. Prosus is also making strategic acquisitions, like France's La Centrale and Just Eat Takeaway, expanding its European footprint. These moves show Prosus isn't just selling assets, it's redeploying capital into new growth areas. The strategy: convert paper gains into cash, buy back undervalued shares, and invest in promising platforms. It's a complex, proactive approach to closing the valuation gap and building a stronger, more focused company. Prosus is actively shaping its future, not just reacting to market forces. For investors, Prosus's guidance is key. The company reaffirmed its full-year revenue target of $7.5 billion and expects e-commerce adjusted EBITDA of $1.2 billion. This confidence suggests that strengths like iFood will offset weaknesses like eMAG. The guidance excludes new acquisitions, making the targets organic and credible. Prosus's strategy, selling Chinese tech stakes, buying back shares and investing in new assets, is delivering cash and supporting the stock price. Operational free cash flow is improving, and EPS is growing. For investors, the bet is on management's ability to balance growth and risk, and to turn Prosus into a profitable global internet leader. The transformation is underway, and for those who believe, the path forward is compelling.